Nick, we've seen a very volatile equity market so far in the first quarter of 2025. So what are your expectations for the rest of the year, or maybe just even take me to the summer, because we have seen a turn down?
Sure. So we viewed the year-to-date pullback in the markets as something healthy, right? The market finished last year extremely over-concentrated and finished the year at a very rich multiple. So, we think that this is sort of a healthy pullback. We have seen some concerns about growth for real GDP and people marking earnings estimates down. I think the key is going to be a policy shift when we get beyond all the discussion about, tariff ping pong and, how that's going to shape out. So could be sort of a tale of sort of a painful first half where this new administration is getting some of the tough policy issues out of the way, and then more certainty in the second half where the market could sort of rally from these sort of lows.
How are you negotiating this tariff uncertainty? It's almost like a purgatory. What do you do in the meantime?
Yeah, so one of the ways that we solve for that risk or mitigate it is in our equity portfolios, we're very focused on quality. And so by that, I mean companies that can actually raise prices in any kind of economic cycle, companies that can take market share. So a lot of the businesses that we've owned for our clients, this has really kind of been an irrelevancy for them. So we own things like middle market insurance brokerage. We own businesses in auto market, auto parts, aftermarket. Some of these businesses really create their own growth and have their own pricing. And so we've actually, seen good returns in the first quarter for clients by sort of being out of the way of this particular issue. But I think for clients, some of them are losing a little bit of sleep at night. For those people that do, you can park cash, in short-term treasuries. There's no shame in earning 4.25% in 6 months T-bills, and sort of take a time out and wait for a fatter pitch to cross the plate.
Is that the best defensive play? I mean, is it cash? Is it gold? And also, can you talk a little bit about this switch from growth towards value? Is that another one of those defensive plays?
Yeah, so I think that, look, the drawdown that we've seen in sort of the AI and AI infrastructure theme, I think was kind of overdue. And so I don't know that necessarily portends a big shift to value, because I think that that's a thematic that's going to run for 5 or 6 years. Ultimately is going to produce a lot of productivity, but I think no question that thematic got dented this year by the introduction of DeepSeek and some other cheaper large language models. And then Microsoft recently discussed pulling back on leasing capacity for data centers. So all of a sudden, I think that some of the air came out of that balloon, and you've had more focus on things like financial services, healthcare. That doesn't necessarily mean switch to value, but a broadening out that we actually think is healthy in terms of market leadership. We like that.
But it sounds like you're still an AI believer. So if you're an AI believer and you want to kind of wait this one out, this storm out, if you will, where would you do it?
Yeah. So, some of the derivative plays for AI are in sort of the supply chain. So you talk to any data center or hyperscaler within the AI space, they'll tell you, we cannot break ground unless we have 10 to 15 years of secured power. So in the US, we have an enormous bottleneck with bringing new power generation online, as well as upgrading 20 or 30-year-old transmission infrastructure. So in electrical equipment and supply, people who make transformers, people who make transmission, and then even in sort of the utility and independent power space, those are businesses that we think are going to be beneficiaries. But also, we are very much believers in software, companies that have 90% recurring revenue, 90% retention. So we think sort of, generative AI software companies that provide companies with real productivity, real ROI, those are looking cheaper now. We're seeing 20 to 25% pullbacks in some of these names. That's exciting.
And then finally, we talked about AI. We've talked about some alternatives. What else is going to be out there over the next 5 to 10 years that's going to be attracting a lot of dollars and attention?
Yeah, so I think the sort of democratization, right, of some of the alternatives that sit between bonds on the low end of the risk stack and then just long-only equities, things like private credit, things like private equity, You've seen this, through Blackstone. You've seen it in M&A recently from firms like Apollo and BlackRock. I think that notion that clients can get sort of an 8, 9, 10, 11% return in something that has half the volatility or less than half the correlation to the S&P, I think that's something to watch. And I think that is, there's a lot of money flowing into that area. And we're sort of looking at that closely for our clients, because those could end up being equity-like returns for the next few years.
All right, well, thanks for coming on and talking about it.
Nice to meet you, Greg.